Hello everyone and welcome to today's webinar here at TradeStation. My name is Don Pratl. I'm the Director of Trader Development here, and I'm very excited about this presentation today because it's very academic and very applicable to your trading activities. Back in 1934, R.N. Elliott conducted a landmark study of stock market trends, and that study showed the prices in indexes are patterned. Elliott discovered that investors as a group swing from excessive optimism to excessive pessimism in predictable waves. In turn, Elliott offered evidence of his discovery by making some very accurate stock market forecasts. What appears random and unrelated, Elliott said, actually traces out recognizable patterns once you know what to look for. And he called his discovery the wave principle, and the implications were huge. Elliott had identified a common link that drives the trends in human affairs, from financial markets to fashion, from politics to popular culture. Today, I'm very happy to have Ben McDowell, the founder of TradersCoach.com, make this presentation to us. He's going to explain to us how to create a market roadmap with Elliott Wave analysis. Please remember that our presentation is for educational purposes only. All the symbols and trading ideas that we discuss here are for demonstrational purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone, and options trading carries a high degree of risk and is not suitable for all traders. I have included in the chat panel 2 pieces of disclosure information and PDF handouts that are available to you to read at your convenience, and you can view them on the TradeStation website. So without any more introduction, let me bring back Mr. Ben McDowell. It's kind of a Ben McDowell doubleheader today here at TradeStation, and we're very happy that he found time to spend with us.
Thanks, Don. It's great to be back here. Yeah, I was talking to Don earlier, and it was kind of like deja vu. We just were together this morning doing the TradeStation morning brief, and here we are back again. So it's great to be back here. Love the TradeStation group. Love the traders here. Great questions, and we want you to ask questions today. So be sure you know how to access the question window here on the webinar. I'm sure everybody does. But we got a really great presentation today. We're gonna talk a lot about the Elliott Wave. How many people out there have seen me in the morning briefs and listened to my analysis of different markets? Because that's where we spend a lot of time looking up stocks and also using the Elliott Wave there. Yeah, of course, a lot of people. And after this presentation, I really invite everybody to come to the Wednesday morning briefing. That's my day, because you'll see me use a lot of the techniques that I discuss here during the brief in the morning as we go through stocks. And we spend quite a bit of time always looking at stocks that you all want to look at as well. So it's a really fun session, and I think I enjoy it, and it goes by pretty quick though, doesn't it? All right, so let's go ahead and get started here. Don did a great job on his disclaimer, but we really like to spend a little time on the disclaimer because we're going to show you a lot of charts today. We're going to give you a lot of information. But, you know, we don't know your personal situation. We don't know your personal financial situation. And so anything that we discuss here, you're going to want to check with somebody that's more familiar with your personal setup. So check with your financial advisor, your attorney, or whatever before actually acting on any of the concepts here, just to make sure they're in tolerance with your risk control and so forth. And you always want to trade with risk capital and use risk control as well. And don't forget, a lot of past performance, okay, does not guarantee future performance. You always have to keep that in mind too. So with that in mind, we look at this as more of an educational content for you to learn more about the topic we're here to discuss. So Don introduced me, but I also like to welcome everybody to the TradersCoach.com website. And we have a lot of free information there and a lot of information on our trading tools. We have a lot of software trading tools, some of which are, of course, geared to the Elliott Wave. So come by and check us out. I think you'll enjoy the website, as we got a lot of good information. I also have written 4 books, and today's concepts are really going to be focused on the book on the far right called Elliott Wave Techniques Simplified. This is my latest book published by McGraw-Hill, and that's available at Amazon and also most major bookstores. Now, because you took the time to be here, we've created, and actually this is what I use as well, what we call an Elliott Wave cheat sheet. And I'm just for a minute, I'm just going to change screens for a second and show you my actual desktop. You should see in front of you now basically a report. And this is what you can get for free. And I'm going to put the link up here right now in the chat area. And if you click on that link, you can actually go ahead and access this report that has a lot of the statistics on Elliott Wave that's really handy to have at your fingertips. So in fact, a lot of people that use this have laminated it and have it right on their desktop. So this is absolutely free for you guys for being here. So take advantage of that. I'll put the link up again later if anybody comes in towards the end of the presentation. But in this, it's a PDF file basically, and there's clear definitions of each of the 5 Elliott Wave characteristics and illustrations of what the patterns look like in case you're new and you kind of want a little refresher. And also we have target zones, how to calculate that in terms of fib extensions. That's great no matter what level of trader you are. Also the rules for Elliott Wave 2 are listed there too. So we tried to put all the important information so you have it handy, okay? And you don't have to keep going into a book to look that stuff up. So it's pretty cool. Now, the next thing we want to discuss, give you a little history about Elliott. His full name was Ralph Nelson Elliott, and Don talked a little bit about this. He was born in 1871, quite a while ago. He actually was an accountant. In 1929, he almost died. And while recuperating, he turned actually from accounting to the financial markets. So he was able to turn that time where he was recovering into a different study of the markets. So he started doing that, and he studied the stock market and the Dow theory in 32. And revealed the wave principle, which is a book he wrote in 1938. And his final work on nature's law was published in 1946, and then he did die in 1948. So the Elliott Wave has been around for a long time. And the thing I love about the Elliott Wave is that it works off what I call observational statistics. Anybody have an idea of what I might mean when I say that? What is an observational statistic? Big word, but what does it mean? Well, it kind of means that a lot of the Elliott Wave, in terms of the percentage of retracements, the fact that there are 5 waves in a trend, were all derived by observing the markets, not necessarily knowing why they do what they do, but observing. For example, if in astronomy, I love to use this example, you have black holes out there that they observe with microscopes, very powerful microscopes. And they realize when matter gets close to a black hole, it gets sucked in. They have no idea really where it goes. They can guess, make theories, but they really don't know where it goes. And it disappears. But they know when objects get a certain distance from the black hole, they get sucked into it. That's an observational statistic. So they don't know how it works, but they know at certain times when objects get close, they get sucked in. So same thing with Elliott Wave. We don't always know why it works. We say it works because of crowd psychology, but we know that when we see Elliott Wave patterns, especially certain patterns, we know statistically that they're going to do things like retracements a certain way and finish trends a certain way. And so that's where we can use that observational statistics to make money. So when you think about the Elliott Wave, I want you to think about it as observational statistics. All right, so why use it? What is it all about? Well, it's a form of technical analysis, and we use it for forecasting price movement for profit. Okay, that's obvious. It encompasses its mass psychology. You also have heard of market cycles. Some people call expansion cycles when the market turns bearish, for example. That's a bearish cycle. So the Elliott Wave lends itself for us to identify what market cycle we're currently in and what market cycle should evolve. From that, we can establish price target zones, and we use Fibonacci extensions and retracements for that. And when we have price target zones, we then can, of course, calculate risk and reward expectations. So when we combine all 5 of these elements, we really get what we call a wave theory which we can use as the roadmap of the markets. And we're going to show you many, many examples of how we do this. So again, just to summarize here, Elliott Wave is not fundamental analysis, it's technical analysis, and we use it to forecast trends in the financial markets, and it's really good on all time frames and all markets. Some people will ask me, well, is the Elliott Wave only good for long-term projections? No. Okay, we use it on intraday time frames, whether it's the S&P on a short intraday time frame, all the way out to long-term time frames as well. There are also waves with inside waves, and so those are represented on lower and higher time frames as well. We're going to cover that. So the wave principle states that collective investor psychology, which is that word crowd psychology, moves from these levels of optimism and pessimism and back again. These swings create the patterns as evidenced in price movement of a market at every degree of the trend. Elliott's model basically says that market prices alternate between 5 waves and 3 waves at all degrees of a trend. And so when we look at a Elliott Wave pattern, and this happens to be Apple stock here, you certainly can see a lot of numbers up here, but the first major leg up is what we call a wave 1. And so that starts at the 0, the beginning of the trend. We'll call this 0 down here, and moves up to wave 1. Then we have a retracement, wave 2, down this way, and then a wave 3 up here. Now wave 3 is the most powerful of all waves. This is a great wave to get involved in, and there's many different ways you can get in to try to get into the beginning of a wave 3. Now we have scanners and so forth that we've developed at traderscoach.com to help us do that, but also too there's advantages of trading from 3 to 4. Sometimes we can get a 100% return, no kidding, on certain wave 4 retracements because wave 3 is so large that the wave 4, when it retraces a fib retracement of 38.2 to 61.8%, will land you quite a gain, okay, in a large wave 3. So that's a very viable wave to trade sometimes. And then after wave 4, it completes with wave 5. And that is the end of the trend. Now this happens to be on Apple stock, and so this was back over the last few years, but this was a great run up. And notice now inside these waves, we've labeled little waves. See the 1s up here, the 2s. So there's waves inside waves. And on the impulsive waves, which are the waves going in the direction of the trend, in other words, wave 1, there are 5 waves in this wave. There's 5 waves between 2 and 3, because that's going in the direction of the trend. And there's 5 waves inside wave 5, which is the direction between 4 and 5. And waves 4 and 2 are corrective waves. And there's usually an ABC pattern. You can see we've marked there as well. So sometimes in a very clear chart, you can actually see the waves inside the waves on the time frame you're looking. Sometimes you have to go to a lower time frame to be able to have the clarity to count the waves inside the waves. But nonetheless, the main thing to take away from this is that each trend has 5 waves in it. All right, so let me erase those drawings and go back to the pointer here. Go on to the next slide. Classic Elliott Wave theory is pretty much what Ralph Nelson worked on. But there's also another element that has been added to the Elliott Wave since the advent of computers. Now remember, when he did all this, there were no computers. We call this the modern Elliott Wave theory. And what we're able to do is combine classic with modern in order to increase the probability of the wave count. We're going to show you how to do that. Okay? So this is a really cool thing when you're able to do this well. But first, let's just go over the classical Elliott Wave first, just to make sure you understand this. So classical Elliott Wave counting focuses on price. We're not talking about indicators here. We're not talking about any of the fancy computer. No matter if you can print a chart, we're talking about the price that is actually on the print that you're looking at. So here is what's interesting, is notice that the diagram in front of you is broken into 3 pieces. You have a month, a year, and 5 years. So in the chart on the left that says a month, notice the 5 waves inside wave 1 labeled by the red 1, and then an ABC labeled by the red 2. Well, if we take this chart and move it over to the right and put it on a longer term chart, now you can see the 1 and 2 in red, which represents just a month, and it's part of a larger trend. And then we take the yearly chart and put it on a 5-year chart, and you can see the 1, 2, 3, 4, 5 from the yearly chart onto the 5-year chart, and that's part of even a bigger trend. So this gives you the classical waves with inside of a wave. So when you're looking at one particular market and you're looking on a daily chart, you should be able to go down to, say, a 60-minute chart, and the structure in a 60-minute chart should indicate the waves inside the waves of the larger time frame. Likewise, if you go to like a weekly or a monthly chart, you should be able to use the daily chart for the waves inside the waves of a longer term chart. So that's classical Elliott wave theory. And here it is again, just in a more clearly written profile, the waves inside a wave. So I think everybody's got that by now. And here it is again, 1, 2, 3, 4, 5. So let me ask a really simple question. How many waves in a trend? All right, good. What waves are impulsive waves? What waves are impulsive waves? Now these are the waves in the direction of the trend. So in an uptrend, doesn't matter if it's an uptrend or downtrend, it's still going to be the same. Okay, excellent. What waves are your corrective waves? What waves are your corrective waves? 2 and 4. Good. All right, excellent. Okay, so once you got that, okay, you understand the basics of Elliott wave. Here is a correction that shows you that even in a correction, there are waves inside an ABC correction. And as a general rule, there are 5 waves in an A wave because technically the direction of the correction on the bearish one on the left-hand side is down. So the impulsive waves on a correction are A and C, whereas B is going to be a bullish. And on a bullish one, the corrective wave is between A and B. So again, A is going to have 5, C is going to have 5, and then the distance between A and B will have 3. So that's kind of the way that looks in there. So there's always waves with inside waves. But also, too, there are times when corrections aren't simple. They're a little more complex. How many people out there have seen pennants in the market or know what pennants are or flags? That's a form of technical analysis. Pennants usually form on complex corrections in the Elliott wave, and you see them a lot on wave 4. That's when they form the most. And these are examples of corrections or Elliott wave complex corrections that look like pennants. And then whichever way it bounces out after E wave, that will be in the direction of the next trend, which will usually be a wave 5. So on the left-hand side, we have a bearish result, meaning that wave 5 is heading down. And on the right-hand side, we have a bullish result, meaning A wave probably represents the bottom, wave 4, and then we had a complex zigzagging ABCDE correction where the result is to the upside of wave 5. So corrections can be like this. They're most of the time they're ABCs, but sometimes they do result in this. And then you can have corrections that just move sideways. You'll definitely know when you're in a correction versus an impulse, and I'm going to show you how you're going to know that soon. How many out there have tried the Elliott wave but found that it's very subjective and difficult? How many people have found that it's very subjective and difficult? Always easy to spot usually afterwards, right? We're going to give you some tools here to take that subjectivity out. But I want you to realize that there's times when you'll look at some certain markets and they're going to be a mess. And it's usually because they're in a complex correction on a much higher time frame that results in a spaghetti market on the time frame you're looking at. When you see that, just move on. If you have to, I always say, if you have to scratch your head more than 3 times trying to figure out an Elliott wave count, you're probably better off moving on because there's a lot that are clear. So always try to find the clear patterns. And we're going to show you some of those real soon. The goal here in this session is really to take that subjectivity out of wave counting for all of you. This is where the modern approach comes in to help us do this. Okay, we use a lot of different types of computer tools to help us. When we talk about the classical approach, we're talking about a combination of classical, but we also want to talk about the modern approach. And when you're doing this and combining the two, call it a connecting of the dots type of approach, because you increase your odds of success. And it's an approach that I've been using for over 20 years, about 25 to be exact. And it combines several key studies and components which significantly increase the probability of the accuracy of your count. So let's talk about these a little bit. First thing is you take into account all the concepts in the classical approach. These are the statistics. For example, wave 2 can retrace 100% of wave 1. That's a stat. Wave 4 can't. It doesn't do that. Wave 4 should not go below the top of wave 1. That's a stat. Most wave 4s end between 38.2 and 61.8% corrections. 70% of them do. 15% of them are a little shy. 15% exceed. All right, so we'll talk about that. But that is some of the statistics you need to know based off classical approach and Fibonacci levels. We also use a histogram indicator to confirm Elliott wave counts too. This is a form of measuring momentum. We know the greatest momentum occurs, as does volume, in wave 3. So as soon as you can find wave 3, based on just knowing what the momentum is and the volume is, bingo. You know where you have wave 3, and if it occurred a while ago, then you should be able to know where you are now based on that. And if you're starting to see current volume and momentum highest now, then you know that you're in a wave 3 now. You also can use different fractals in the market. These are used in order to find pivot points in the market that represent the waves inside waves. If you see channels or pennants like we talked about before, then you know you're probably in a wave 2 and 4 and not in a wave 3 or one of the impulsive waves. And then you can assign a probability matrix, what I call a probability matrix, which is what I did is I created a percentage that I assigned for each one of those elements in order to see how probable or high probable those percentages worked out in terms of my count. So all that comes into play. And then, of course, there's risk control. You have to always use that no matter what you use. $1 million question, does all this work? Well, there are 6 areas, again, to focus on when talking about my probability matrix and connecting the dots. We've gone over this. Multiple time frame alignment is also important, and we're going to take a look at that as well. So we're going to cover all this. Now, this is a chart of Apple a while back. And some key things I want to point out here. Notice, let me get my pointer again up here. Notice that in this, we have some indicators at the bottom now on the chart. So now we're not looking at just price, but we're also using the computer to help us. So we're bringing in what we call the modern approach and using it in conjunction with price. So all the statistics in terms of retracements from 3 to 4 all have to fall into the correct statistics based on classical Elliott wave theory as derived by Nelson. So that's one of the things we have to take into account. Things have got to be in alignment in price, but also too, what helps is that when you see a steep move like this in price, that is usually a wave 3. But you want to make sure it's a wave 3 and not a wave 5, because if you look over here, you also have rather steep price movement. But notice here that this histogram that we use to measure momentum is lower in value than it was during the wave 3. So that's a modern approach rule. The momentum histogram, we call it the optimum wave locator, there has to be bearish divergence, okay, in a bullish wave 5 top between wave 5 and wave 3. If you don't have that, you don't have a wave 5. So that's one thing you got to keep into account. The other thing too is that if you're in 05, you've also had to have had a wave 4 ABC correction for a wave 4. And there you have that right there. Now you also have to have a negative momentum during wave 4, and even though that's green in color, but that is below the 0 line, so that's technically negative. There is your negative momentum, And that is a must as well. If you have a pullback, but do not have negative momentum in that particular indicator, then you do not have a wave 4. So that's a great way that you can ferret out pullbacks in terms of, are they minor or are they significant enough to be a wave 4? And if you get a negative indicator and it reaches the target zone, which is in between these two lines here in this example, then probabilities greatly increase on your side that you now have a legitimate wave 4. And when momentum comes back, meaning the momentum rises above the 0 line and prices head back up, then that's a strong probability you're now in wave 5. And so once we have that, then you can go ahead and draw your fib extensions, which give you your target zone up here for wave 5. And there's your forecasting tool. All right, so that gives you an idea. If you're sitting down in this price level here and you want to know if the trade's worthwhile to take, you now have a target zone based off a fib extension, based off anchoring the fib extension at wave 2, 3, and 4 to give you the target zone in wave 5. And that will tell you whether there's enough gain or profit to be had to make wave 5 worthwhile. So that's just one example. Then this is a short trade. Not only do you have 5 waves in bullish trends, you have them also in bearish trends. And again, look for some of the similarities that we talked about before. During wave 3, we expect some quick movement in the direction of the trend, as established by the fact that it's moving down. Notice that we have here a pretty powerful negative momentum. Notice here it rose into a fib retracement zone, and the optimal wave locator, which measures momentum, turned bullish. And then notice here it went bearish again, and we then saw a selling of price where we could start drawing in our fib extensions to get a wave 5 target zone. So once you understand how to find wave 3, you can then locate opportunities for other wave trades, but you can also, guess what? What happens when you get to wave 5? Well, then you get the end of the trend. Then you also have an opportunity to catch the next trend, and you can get in early on wave 3. So once you find wave 3, a lot of magic can happen. All right, let's keep going on. All right, here's a stock called PEIX, another one that we've marked up for you so you can clearly see using a modern approach in conjunction with the classical approach. And on this one here, notice the other neat thing too is if you can find markets that are channeling. How many have heard of fry pan handles? Okay, fry pan handles usually occur when markets either have sold off or just bottoming and they're going sideways. Big trends can come out of markets that have gone channeling or going sideways for long periods of time. And usually when they do, they start to break into a brand new Elliott Wave pattern. So it's a great scan for you to find that first wave 1 up. And wave 1, as you can see here, labeled here 2, and then you can see wave 3 moving up powerful. But notice that wave 3 in this example, you had to move up and then it settled a little bit. Look at it, settled over here and then it moved back up. So it wasn't a pure straight line. But look at the owl. The owl is powerful, especially compared to all the rest of the history. So when you have that and you have a bullish move of significance, I mean, the price went from $4 all the way up to $14. That's huge, percentage basis. Then you're in a Elliott Wave 3, all right? Plus, we have some other indicators that we haven't talked about, the PTF This is something that also, when it's green, we usually see a lot of green during wave 3. And then you have trend lines as well. Trend lines are usually easily to plot during a wave 3 because wave 3s, for the most part, will be fairly orderly. Then after wave 3, pull into a correction into wave 4, and here is our Fibonacci drawn target range. This is, I don't know if you can read that very well. I can barely read it, but it looks like it's 61.8 to 38.2. Well, that's what it is, but I can't read the exact prices. But in any case, it pulled down in there, and notice that the owl had to be negative for that, and it was. And then prices climbed out, momentum changed again. Look at the owl in wave 5, and we're off to the races for wave 5. Now, David's asking, is wave 5 the end of the trend? Yes, wave 5 is the end. So when it gets in this target zone, we can expect it now to end this trend to the upside and change direction, okay? Or maybe go sideways for a while. But the the trend up would be ending at that time. So that kind of, is very clear, but you can see how helpful it is when you add the modern approach to help us count as well. I mean, you can almost count the Elliott waves by just using this indicator once you understand how it works. Now here, I want to go back quite a ways. As I get older, this gets further back. But this was basically the 2000 bubble for the dot-com. How many people were around for that? I guess I'm kind of showing my age here. If you remember in the 1990s, especially the late 1990s, you couldn't go to a cocktail party without hearing about trading, right? I mean, especially day trading. Everybody was talking about trading. I mean, the euphoria in the markets. I mean, look at this. This was 94 all the way up to here, to where it busted. Straight up, okay? Pretty obvious. Now, I don't have any other indicators on here. So I don't have the modern approach here, okay, on here. But just focus on classical approach for a minute. Pretty easy to see that wave 3 is powerful, isn't it? So back in that time period, as this market was climbing, this was a 4. Notice this little 4 here. Remember, there's waves inside waves. So this was a 3, 4, and we were on the last leg right after, what was that, 98. And then it pulled back up to the top. So we knew we were getting close to the top. And then, of course, as soon as it busts and start taking out support levels of significance on wave 3, that's the sign it's over. You can draw your fib retracements. And our retracement area, put it right in this area here. And do you know that the markets came down to that area, stopped, and then took off again? So what's interesting about is we were calling, and I was managing money. I was working for Prudential at the time. And during this period, we were calling for, a little bit of calm here. And yet, people were just pounding in the markets. Problem with that is once it broke, people were over leveraged, and that caused great problems in the markets back then. But what's interesting is that if you did the fib retracements, the actual retracement area was really between about 7,600 down to 6,500. And I got to tell you, in the late 1990s, when you told people that was where it was going, they thought you were nuts, because the euphoria near a top just wouldn't allow that kind of thinking. And, that's exactly what it did happen. Eventually, it did break down. Unfortunately, you never know what's going to cause things to come down. But one of the interesting things about the Elliott wave is that there are events that come along that cause these motions in the market to occur. Again, observational statistics. So markets came down. You had 9/11, unfortunately, and it reached down that level, and then you had a recovery after that. Pretty powerful stuff. It really is. To me, it's amazing how accurate it is when you can identify certain patterns in the market. All right, so now what I want to do is I actually want to switch here. All right, let me go to screen sharing a minute. And I want to take a look at a couple things. All right, here's TradeStation. You should be able to see my chart now. So let's take a look at the Dow right now. And on this, I've drawn a chart here. And notice here that I have wave 3 indicated up here. Notice we're seeing bearish divergence building inside 3. We haven't had a major 4, okay? We've had a little bit of a red owl here, but we had no pullback that reached into the fib target zone. So remember we talked about connecting the dots. So if you have a little bit of red in the owl or measuring momentum, it's not a wave 4 until it reaches a fib retracement level. It's got to come back for that. So in this case here, we're still, it looks to us like we're in a wave 3, but we've bracketed. We've noticed two areas that we want to keep an eye on. One is the upper area of 21,070.90. This is a resistance level that occurred here, and then 20,379.55. So we have bullish momentum, we have a bullish PTF and bullish trend lines. So in order to really see what the market's going to do here, we really needed to go to a lower time frame. So I'm going to show you that in just a moment. But things are setting up for this to be, we're getting closer to a wave 3 top, but we're not quite there yet, we don't think. But we do have bearish divergence, but you know, bearish divergence can last a long time. But so far from a technical standpoint, we're still in an uptrend. Now, if this failed today and broke down below the support, then we've drawn in a fib retracement area here that would represent a wave 4 based on the current price activity in the Dow Jones Industrial Average, which would take it down to 18,996 to 17,641. After that, we expect more highs. But first, before that can happen, wave 3's got to be over. And we don't necessarily think it's over. And so let's take a look at another time frame to show you why we think that. So I'm going to come back to the longer term time frames in just a minute. But here's the 60-minute time frame. Now remember I talked about waves inside waves. So now we're putting the daily chart under a little bit of a microscope. Okay, we're going into an intraday, but a long intraday time frame. All right, so this is the 60-minute chart. Same chart you looked at before, but 60 minutes. So each price bar represents 60 minutes. So on this chart, we have a little bit different configuration. And notice here we have a wave 3, we have a wave 4, and we already measured the fib retracements, and it was fine. And now we're climbing into a wave 5. So when wave 5 ends, that's going to be, we think, the end of wave 3 on the daily chart, because there's 5 waves in a pulsive wave 3, remember? So there's waves within waves. So there's 5 waves in 3. So when we get to the end of wave 5 on the 60-minute chart, that should be the end of wave 3 on the daily. We're looking at a top here of between 22,179 and 23,325. And then this will show a change in trend. And this will go into a major wave 4 on a daily chart. Now, after wave 4, there's a wave 5. So we're not saying we're at the end of wave 5 yet on the daily. We're just going to go into a contraction on the daily that could last, several months. We don't think that's going to happen right away. It's got to get up to this target zone first and then roll over. So we got time. But that's kind of why we're thinking it's going to resolve to the upside instead of breaking down. So let's just run real quick back here to the daily chart. So now that you had a glimpse at the lower time frame, what we're saying is we're breaking a break up into here, get up into this range here, and probably reach eventually the top of wave 3 here. So wave 3 is still unfolding. Then we're going to have to redraw these fib lines because they won't be accurate anymore and get a new fib model, which would be higher. Okay, it'll be a little bit higher at that point. Basically, once you find wave 3, you can really isolate where you are. Now, if you want to trade the next major wave down, well, you're going to have to, if you got in now, you'd be getting in late on wave 3. So that's not always a very smart thing to do. So you always want to try to get in at the beginning of waves. So whatever wave you're in, you've got to assess whether you're at the beginning, the middle, or the end of that wave. And that's going to determine whether you really should get in, because that's going to determine whether there is enough profit potential for you to get in as well. So there you have that. This is a weekly chart of the Dow Jones. So we're still in wave 3 on this chart here. Hasn't broken down yet. So that's still heading up as well. Now when this ends a wave 3 on the daily, then we'll have some type of pullback here on the weekly at that particular point too. And we'll have to see if that is enough to make this go into a wave major wave 4, I don't think it will be. I just think it'll be a pullback in the overall 3. And then if we go into the monthly chart, which is this one here, where each price bar represents a full month, and you can see where we had the turnaround in 2009 here, and then it marched on up. Technically, everything is bullish. There's no bearish divergence anymore. So we're right in the meat of wave 3. Until this ends, technically, we're in a bullish long-term run. And, you know, when this goes into a major wave 4, that will last quite some time. But after that's over, then you'll have a 5 there too. But for right now, believe me, when this hits a wave 3 top, it'll be very dramatic because that'll be a big turn down. But we're not near there yet. So, you know, in terms of long positions right now, I would stay with them. That's my suggestion. And certainly it seems like things are good. They should remain pretty good for quite some time. So I think you're probably in pretty good shape. So that just kind of gives you a little of an idea. Now, the other thing I wanted to do is go into TradeStation a little bit. Here's NVIDIA. Anybody trading NVIDIA, by the way? What a wave 3. That's a wave 3. Look at the owl. There's no red in any of our indicators down here. And it's been that's a clear shot. So now, if you missed it, so what can you do? Well, you've missed wave 3. So now you possibly can figure out where wave 5 will be. You could calculate that. Or you could move on to another market. If you go to, here's NVIDIA again, but there's many stocks. In fact, somebody give me one out there. Let's see. Anybody know of a good trending stock they want me to look at? I'll just do one here. All right, let's go to Netflix, okay? NFLX. Now, I'm on TradeStation right now. Phenomenal platform. You all know that already. You're using it. I've got it set up so I got a 60-minute on the left, a daily in the center, and a weekly chart on the right-hand side. And so I use multiple time frame analysis when I take a look at different stocks. So beautiful trend up. Now, look at this on both the weekly and the daily. Huge move up. Let's go to the daily here and take a look at that. Let's see what we got cooking. So we had some movement up before too as well. Well, what's the highest owl? This one. So this is a wave 3 that you're in right now. All right, that's using the modern approach along with the classical approach. So you're in a wave 3 right now. You're seeing bearish divergence, aren't you? Okay, we're seeing bearish divergence here and here. So a little late to get in, all right, because this has been underway. So the next thing you could possibly look for is maybe a wave 4 trade. Now, does anybody know what a wave 4 trade may look like? Well, let's take a look and see if there's anything out there that could be a wave 4 trade. How about, let's see, let's take a look at a couple of them here. How about RIG? Let's take a look at RIG, maybe one. Okay, so here is RIG right here. And notice we have the fib channels drawn in. You can spot wave 3. Look at the huge move down. So wave 4, all right, should end up in between those two blue lines. So if we go down here, draw a 3 here and a 4 here, we know based off the fib stats that 70% of wave 4s do make it between these two lines. 15% make it just shallow between 23.6 to 38.2, and 15% go beyond. So we always shoot for the high probability target zone. In this case, that's between 25.98 and 37.38. We're at 11.17. So what do you think? Not a bad return, 100%, right? So one of the keys with trading this 3 to 4, we missed 3, right? Let's just theoretically say you didn't show up in time for 3. Don't think all is lost because there's always a wave you're in. So the next opportunity, is there an opportunity for wave 3 to 4? You betcha. With that kind of return, you betcha. Key is keep your stop low on the bottom of wave 3 and don't move it until you get into the 15% range. And then we have a whole structured way of handling that. So the way to get to the wave 4 target zone is to not move your stop up too quick. Most people don't make it because of that reason. Anyway, if you like this kind of analysis, come to Wednesday morning's market brief. I do these every Wednesday. Don can vouch to that. We look at tons of stocks after we look at the markets. It's a lot of fun, and we use the Elliott Wave for that. So let me go back to slides here. And let me now, I just want to put this link back in, I guess, for those folks that did not see this or got in late. This is a link that's going to take you to what I've created. It's called an Elliott Wave cheat sheet. And I want you to have this. It's for your desktop. You can laminate it, do whatever you want with it. But it has all the stats you need okay, for retracements and so forth. It's really handy. So you can get that there. So let me just see if there's any questions out there. I don't want to spend time looking at live markets. Let's do that on Wednesday, or else we'll be here all night. But any questions on what I covered or anything of that nature? Here's a good question. Does Elliott Wave work for trending markets only? Well, you know, in order to make money, technically, unless you're an options trader and are making money off time decay from a market that's not going anywhere, you kind of want to be in a trending market. So the idea is when a market is trending, it'll trend in those 5-wave patterns. So the idea is if you can get in early, ride it all the way up to the top of 5, that's a trend and you're going to make money. So in terms of speaking about Elliott Wave, it works in trending markets, yes, but also if you see a non-trending market, chances are you're in a corrective wave in that market. Wayne's asking any scans. We actually have an Elliott Wave scanner, Wayne, that identifies wave 3s and 5s. And once you identify those 2 wave concepts, we have a whole bunch of trading scenarios and how to make money on that. So check out our website on that. Rebecca, can you repeat where the bearish divergence is necessary? Is that at the end of wave 3? It's between, let's just go back and see. Let me find a slide here. Go back here. Okay, so let's just go to PEIX here. Good question. All right, notice here, 3, you have 3 here, right? Circle that for you. You have 3 there, and then you have 5 over here. So you will always have bearish divergence between wave 3 and 5, always. You do not always, even though you did in this case, you don't always have bearish divergence inside wave 3, but always, you will always have it between 3 and 5. So if you're in a wave 5, this owl cannot be higher than the wave 3. What happens if it goes above wave 3? Good question. What happens if it goes above wave 3? A new wave 3. Excellent, Wayne. Right. Okay, that becomes a new wave 3. Stop losses. That's a whole different topic. Basically, we use the ART system for our stops, even when trading Elliott Wave. But again, if you can get in at the beginning of a wave, let's just say you got in right here at the beginning, you know, let's say you spotted 1, 2, and you got in here when 2 cleared the top of 1. If you put your stop down at the bottom of 2, you can leave it there. You can really leave it there. And then when prices get up here and start to falter and come down, you can get out. If you're going to trade wave 3 to 4, the correction like I showed you on that other chart on TradeStation, same thing. Get in as early as you can, then put your stop on the other side of the major wave. It's really that simple. You can do that. The key is getting in early. You do not want to get into wave 3 up here. Every time you get into a trend late, it's more risky. That's one of the things I don't like about sector scanning is usually if you find a great sector, the stocks have already run up. So it's kind of like playing Russian roulette and getting in late on trends. Try to find the stocks or the markets that haven't rotated yet and have just begun to trend. Great question. This is a good question. What is the lowest time frame that the Elliott Wave works? What is the best? Well, technically speaking, from a theory standpoint, you can go all the way down, I'll say within reason. You got to be able to see, I think, structure in the market. If you go down to the heartbeat of a tick, I'm not so sure how that would work. But in the real world, you could technically go down pretty darn far. I, for example, trade, when I day trade, I'll trade the 2-minute S&P E-mini, and it's very clear on that. But you know, we have people that trade even lower than that, okay, that use it. So it's pretty cool. Good questions. Can a huge ABC after wave 5 go below the start of a previous 1, 2, 3, 4, 5? Usually what happens on that is after a wave 5, you can go into a major ABC, and it's usually represented on a higher time frame. And usually what happens on the time frame, like you might have an ABC on a weekly or a monthly, and it will appear as a new trend down, 5-wave trend on the daily. But in that case, once wave 5 is over, technically anything can happen in terms of a change in trend. It can go into a large ABC or a 1, 2, 3, 4, 5. Chances are, if it starts to really go below in a major way, then chances are that is a new trend in the opposite direction. Good questions. All right. Dimitri, Ben, do you use a scanner? I do. I use the, we created something called the Elliott Wave scanner, and we use that inside Radar Screen. How many people out there use Radar Screen? If you're not using it, you should be using it. It is a tremendous scanner. All our setups we find using Radar Screen. And we have programmed some custom scanners in that as well. Does this work on futures day trading? Absolutely. Works on, if you have price present, trends on all time frames, because there's waves within inside waves, move in these 5-wave patterns, regardless of the market. Do you have a system for trial and TradeStation? I'll tell you, all our software tools come with a 10-day money-back guarantee. And I got to tell you, our support is second to none, because every week I hold a live client support session where I actually teach you how to use these things. So people are pretty happy with that, and it's a good program. Our licenses are all one fee, okay, lifetime license. Yes, the OWL indicator is my indicator. All right, so let's get back on topic here for actual Elliott Wave. Now, let me ask you a question. Did I do an okay job showing you how the Elliott Wave really is the roadmap, can be used as a roadmap for the markets? Okay, good. Excellent. Because that's the goal here. I want to depart some information that you can use here. That's the key. Now, there's going to be times when you look at a chart, like I said before, and it looks like spaghetti. Move on to another market. There is an Elliott Wave there, but if it looks like spaghetti, it's probably a correction, and you're better to move on. Excellent. All right, well, let's move on. Everybody got the link for the cheat sheet right there? Okay, good. All right, well, we handle questions. If you want to learn even more about it, you can check out my book on Amazon. That covers it too. Covers all the connecting of the dots and stuff like that. Then we also have an online home study course as well. All right, well, listen, I want to thank everybody for attending. What a great group, great questions. And I want to thank everybody at TradeStation for having me today. Don, thank you so much. It's great to be here. I really enjoy working with you, as I do everybody at TradeStation. Again, thanks for coming, and I hope you got a lot from it. I enjoy being here, and I can't wait to be back one day. So, Don, I'm going to turn it back over to you, and everybody have a great week, okay?